What's going on, guys? It's your boy Adrian, and I'm back again with another video. If you guys have been tuning in lately, you know that I like to keep these videos short and sweet, straight to the point. So that's what I'll be doing again for this video. In today's presentation, I'm going to be discussing the liquidity sweep trading strategies. I'm going to be going over two examples, mainly on the 4-hour time frame. But just keep in mind, this strategy works on all time frames, right? So I'll be, as usual, I'll be going over my entry and exits, risk to reward, and and I hope you guys enjoy, man. So you already know, let's get it. All right, guys, so let's get to it. All right, so what first thing I'm gonna do is I'm gonna clear the chart, right? I'm gonna get rid of all of this, but the pair that we're gonna be looking at is the Euro USD, right? So all right, and as I mentioned earlier, right, I'm going to be going over two examples. So this is going to be example one. All right, so example one. First thing is, right, we're going to look at so we're on the 4-hour. Right, we're going to look for some liquidity, right, that needs to be pulled, right? So I like to look for liquidity and then look for where price or where the banks are looking to make a fake out move and then eventually push price into their intended direction. So so let's, like I said, let's go to example one. We're going to look at let's see, so let's look at this area right here on the 4-hour. Right, so whenever you see like small wicks, right, in other words, like liquid consolidation, right, small areas of consolidation, this is a signal of, or a sign of, liquidity, right? We have multiple orders, so this is our liquidity. This will be our liquidity area. This area right here is liquidity, right? We also have trend line liquidity, so you want to be on the lookout for that as well. This is an example of trend line liquidity. Right, I'm gonna draw another one out for you guys. Right, and once you train your eyes, right, the more you do it, the more you spot these areas of liquidity. The easier it is. Easier your eyes will be able to notice it and which will result in you capitalizing more often. So let me just draw another area of liquidity for you guys. Here's another trend line liquidity. See, we have a break, a retest onto the fair value gap area, and then price continues down to the downside. So all right, so let's get to the example. So as we see here, we have liquidity. Prices eventually moving to the upside, right? So we have liquidity right here. Let me get rid of this. Right. So once price grabs this liquidity, right, we got two areas, interest areas, right? Because we have two gaps. So what I do is I highlight my areas of interest. So that's one area, and then this is my second area of interest, right? Those are our two fair value gaps on the 4-hour. So once we see this, we see price broke this liquidity zone, right? We have two fair value gaps, fair value gap 1, fair value gap 2, where price could potentially bounce off of and then continue to the upside. So what I would do is I would actually go down to the lower time frames, and I'll get a higher risk to reward entry But for this example, for this video, right, to keep it short and simple, we're just going to stick to the 4-hour time frame. For example 2, I might go break it down a little bit further into different lower time frames. But so what I would do is, right, so once I see this area of liquidity, I would then have my my buy limit. So I'd have one buy limit right here. My stop loss would be right under this wick, this low. Right, as you see, we would have gotten, I probably would have, you could either have a sell limit or you could wait for, if it was a sell limit, we would have got stopped out. But if you would have wait until you saw this engulfing candle, you could have entered and then potentially target the most recent 4-hour high. But as you see, that would have ended up in a loss. But your next entry, right? So that means that fair value gap is invalid. My next entry would be the second one, right, which would be right here. So that would be my entry, right above the gap. Stops would be the bottom of this wick. Take profit one would be this high, this 4-hour high. Take profit would be that 4-hour high. And just with that trade, it's in itself, that's a 5-to-1, right? We have multiple opportunities to scale in. Not to mention, our second take profit could have been this high, right? Could have been this high. So that which would bring our risk to reward to a 7-to-1, right? So that's just one example. And look, price continued to push forward, push up. So that's just one example. Right? Let's see if I can find you guys a better example, right? All right, so look, boom, here's another example of liquidity. So we got liquidity. We got trendline liquidity right here, right? Price, right? Our retail traders, they see this trend line and they're thinking price is going to continue trending up, right? But if you're an institutional trader or a smart money trader, you'll know that this is potentially a fake out move, right? So prices, you got liquidity, the trend line liquidity. Price breaks the trend line liquidity at 5 o'clock in the morning on a Thursday, and instead of getting in on a breakout, we are targeting the most recent gap, most recent fair value gap, which is right here, right? So we would have our sell limit. Our stop loss would be above this wick, right? That's wick. Sell limit would be right there. Our TP1 would be the most recent low, the most recent 4-hour low. That'll be TP1. And TP2 could be this most recent low, right? So, or we can continue. Yeah. So I'll just leave it at that. I can go down to I can go up to move to the daily time frame to see if I can, if I spot opportunities to hold this trade even longer. It just depends, right? Or depending on how much you're risking. Let's say you're risking, 5%. You would be risking 5% to gain 25%, right? So let's say you have $1,000 account, right? You have $1,000, right? You want to risk 5% on this trade. You do $1,000 multiplied by 0.05, you get $50. So you're risking $50 to make, so 50 times 5 to make 250. So you're risking $50 to make 250. So you might be asking, how do you figure out your lot size, right? So if you're risking $50, right, our stop loss on this trade was 20 pips. 20 pips to gain 100 pips, right? So if our stop loss is 20 pips, right, we're gonna do 50 divided by 20, and we get $2.50, right? So our lot size that we'd be entering into our MetaTrader or our trade locker or whatever our trading platform is gonna be $2.50, right? So we hit our target of 100 pips. $2.50 times 100 is $2.50. So that's our profit. So that's how you calculate your lot size. Now, as a bonus, what I want to do is I want to go down to our lower time frames, right? So let's just say we go down to, we can do the 1 hour. Let's just go down to the 15-minute, right? And let's look at our area of interest. Our area of interest, which is this grayed out zone, right? Let me show you how you can scale in and get an even higher risk to reward, right? And look how price tapped into our area of interest and just immediately went to, like, there was no consolidation. Price went straight to our take profit, right? So if we go down to the 15-minute time frame, whenever you see a wick like this, you can expect price to come into 50% of it, right? So we got outside. I would have this zone highlighted for 50% of this from this area to the top of this wick. 50% of that area highlighted, and then as you can see, we have our another fair value gap right here. But as you see, it's been already liquidated. It's already been liquidated. This area has already been liquidated. So that area is invalid. So we have this long wick right here, which we can expect price to come up into 50% of that wick, which, as you see, it did, right? It almost did. It barely did. So I would look for another opportunity to come in this area right here, with my stop being above this wick, which is at what, 0746. So 0746, well, I would have the same take profit, so this would bring my so just this trade alone would be a 14-to-1 RR. So altogether 14 plus 20, right, we would have this is called round up to 8. We would have an 8 pip stop loss with 100 pip gain for 100 pip gain, which will equal to a 14R. So 14 plus 5, that's 20%. So if you're risking 5%, so if you're risking 5% to gain, right, and 5%, that's 100% return, right? So you're risking 5%. So if you're risking 50, right, you're risking $50 on this trade. So you're risking a total of 10%. So it's $100, right? You would have made 100 plus times 20. You would have made $2,000. So you would have doubled your account on this one trade. Well, it would have been two open positions, right? So you would have doubled your account by only risking. You would have essentially you would only risk 10% to gain 100% on one trade, right? To me, that's a decent risk to reward. But like I said, man, if you guys have any questions, just leave them in the comments below. Shoot me a DM on Instagram, and also be on the lookout, man. Keep those notifications on. I'll be dropping more videos like this, man, to give you guys more clarity, man. Hope you guys liked it and enjoy. Hit me up, man, in the comments and let me know what you guys think. Give me some feedback. Peace.